add-ons to the existing platforms. So these are to cater to different, different needs, right? Different customers'
So it's like
needs.
the Binni indicator.
Yeah, correct, something like that.
That's cool, isn't it?
Yes, I built that a lot, but now we are going 100% auto. Hope to that the golden goose to lay golden egg on.
A bit like Trading Central lah, right?
Yeah.
These people, like, they just have the algo and then it's just automated, right? You feed whatever stocks you want, or I mean just the algo to sieve out what.
Yes, correct. Yeah.
Well, all I can say is you're on the right path. I'm a tech idiot, no Binni.
Tech idiot.
And I just always find tech unreliable. So when cloud strike happened, when just different things, right? I'm like CC. So I'm just one of those laggards. And in this future world that we're approaching,
You have two phones.
well, that's a work phone. Because later as you talk, I want to check whether my website is working well. But yeah, like the current world, or rather I would say, luckily I'm not born into our kids' generation. But I really just,
Your daughter is still not yet in it yet.
God knows what kind of world it's going to be. Like now they already, my nephews already saying, now we need to study, and then go check GPT for everything, Like what do we need to memorize? Then exam cannot use calculator. Like real world where nobody use calculator.
Good evening, everyone. My name is Joseph, and I'm from Moomo's integrated marketing team. So thank you for joining us today. Yep. So before I start, just some housekeeping. So later after this event, when you leave the office building, so just call out to the security guards to let you out of the gantry. And also kindly note that there's food prepared after this event. So I think we should end around 8, so you can start eating around 8 p.m. Yeah. So I just want to share a bit more about what's happening today. So there's two audiences today. So people here with us physically, and we have people watching us live on the app. So for people here watching us physically, I assume this is our first time here in our new office. We moved here like 1 month ago. So I'm very happy to say that we are happy to host you here at this event. Yeah. So before I pass the time to the two speakers, let me give you a very brief introduction of them. So firstly, we have Binni Ong, who is currently a SGX trainer at SGX Academy. She has her own Institute of Banking and Finance funded training course, and she also has more than 15 years of experience in providing training and education to both institutional and retail clients. And secondly, we have Chung, who will be sharing with you how you can leverage warrants in your investment portfolio. Jamie is the head of Singapore Warrants at Macquarie, and she has a lot of experience in terms of educating investors. I believe it's more than 16 years. Yeah. So now I'll pass my time to Binni.
Hi, good evening. This is Binni here. Thanks for joining me and Jamie today, both physically and as well as online. Have you had your dinner yet? Yeah, that's my usual starting speech. All right, let's get started. I'll be talking about the US market. So before that, let's move on to the disclaimer. As usual, today, no financial advice. Whatever that I'm going to talk about will be purely educational. And agenda today is hot topic, rate cut. Just now when I was here, I was being interviewed by the newspaper, also on rate cut and fixed deposit. So I think this is a very hot topic, but I'm not going to talk about rate cut. I'm just going to talk about a little bit more into the yield inversion. Anybody heard of this yield inversion? It was a very hot topic. I think somewhere around 2023. Jan to March. In fact, I started presenting on these yield curve inversion around 2022, about November, December. And somehow that was hot topic then, and suddenly it died down. And I'm just going to bring this to attention because there's something interesting. And of course, to talk about going forward, that means that after yield inversion, after we've seen the yield curve inverted, then what's up next? So to give a bit of an introduction myself, I'm Binni here. Not sure whether I look like this in this photo or whatever photos that you've seen. I'm also posting quite actively in Moomoo. So later on, I have a QR code. You can follow me there as well. One of the things is that I do speak on quite a variety of instruments, whether it's equities, whether it's derivative like futures, or is forex, is commodities, gold, oil, etc. And one of the things is I'm doing a lot of automated trading, and hence that's the reason why I can be here talking while my trades are running automated, sorry. All right, so you do see also myself in the newspaper. Just look out for my names, whether it's the Chinese or the English newspaper. But one of the topic that attracted you guys to be here is this one, where Temasek is going to invest 30 billion over 5 years. I think the keyword is 30 billion and as well as 5 years. All right, but I'm not going to talk about which sector, okay, but to bring in generally how to observe the indexes, because we are talking about a span of 5 years and as well as what's going to happen right now. So I'm going to focus on now, and then how to use now to analyze a little bit about the movement of broadly two indexes, which will be NASDAQ as well as S&P 500. All right, so let's talk about the yield curve. How many of you heard of this yield curve inversion before? Let me just know by a show of hands. Okay, only 1, 2, not a lot. All right. Now, what is this yield curve inversion? Now, it means that if we are buying into the longer dated bonds, something like 10 years bond or 30 years bond, we should receive more interest. Okay, then versus if you are buying into a 1 year or 3 years bond. All right, that should be that concept. It's the same thing as investing or putting into fixed deposit. If you put, let's say, a 24 months FD fixed deposit, you will have more interest versus if you were to take out a 3 months fixed deposit. However, when the yield curve invert, it means that if you invest or buy into a 30-year bonds, you receive lesser interest than versus a 3 months or 3 years bond. So you receive less yield, all right, if you were to invest for a longer period. Now, how to understand this? That's because if you understand the relationship between yield that we receive in a bond versus price, they are inversely related. That means that if the yield is to go down, it means that the price of the bond moved up. So why is it that during 2023, during Jan and to March, right, why is it that the world was so concerned about this yield curve inversion? Okay, why is it that when you buy into the longer dated bonds, like 10 years, you receive less and yet people are still buying? Why is it that there's lesser yield? That's because the price actually increased. Because as people kept buying into the longer dated bonds, right, the price increased, hence the yield dropped, because it's inverse relationship. Okay, so why is it that people are interested to buy into the longer dated bond? Any thoughts here? Okay, let me just give you the reason. There are many reasons, but one of the key reasons is that there is a surge in demand, resulting in many people buying, hence there is a surge in price. Because of the inverse relationship, then the yield drop. Then why is it that many people are looking to buy into the longer dated bonds? That's because they fear that recession might be coming. So this is one of the key reasons for the yield curve to invert. So here, I'm going to present to you the latest chart on the yield curve. Okay, so for those who are here, you can see, although I can't point you this, but anyway, you can see that anything that's below 0, okay, below the green line, that's when the yield curve invert. So this graph here, the one on top, the one in black, would be where I took the 10-year yield with the 2-year yield. So 10-year yield minus the 2-year yield. So anything that's below 0 would be where the yield curve invert. So we've seen in the past, although the history doesn't give us a lot of information, all right, and we don't have a lot of times for that recession to happen in the US, but what we've seen during the dot-com bubble burst, anybody remember the dot-com bubble burst? 2000, yeah, okay, and then the 2008, where the US housing collapsed, we have the subprime, Okay, and that led to the fear of the recession. So that was also another occasion where the yield curve inverted. And during COVID, during 2020, during COVID, the yield curve nearly inverted between the 10 and the 2. Okay, but starting from late 2022, all right, to the early 2023, we saw the yield curve went into inversion. And that was where the whole world was talking about that. Okay, now a few things to remember. When the yield curve inverts, it doesn't, from the history, it doesn't lead to recession immediately. Statistics from the past shown that recession will come in 6 to 18 months. I repeat, 6 to 18 months. All right, so if you see the first time where the yield curve starts to invert until now, okay, the yield curve starts to invert early or late, maybe December 2022, and until now, how many months then? Approximately 17, 18 months. All right, but what is most interesting in this chart here is to look at the correlation from the yield curve inversion to that bottom of the chart where I presented S&P 500, and you start to observe, you look at magnifying glass and look at it, right, where the stock market crash. When I define crash, that is dropped by more than 25%, would be when the yield curve after inversion starts to normalize. What is normalized? It means that the yield curve that's below 0 starts to hook up and cross up to 0. So it means that normalized means that the longer dated bonds, like 10 years, starts to have more yield than versus the shorter dated bonds. Then when would this happen? It happens when Fed cuts rates. Okay? So we've seen in the past, right, that if you take a look at the correlation, whenever the yield curve normalizes, few months later, about 6 months to about 9 months, or even almost immediately, when it starts to normalize, right, then you start to see that the stock market starts to correct. All right, and today, with what I presented here, is that the yield curve is very near to that 0 line. Very, very near. If you can just come here and have a look, all right, it's really very near to that 0 line, and we are talking about a rate cut in September from the Fed. All right, and nobody knows the implication to the rate cut, whether it's a 25 basis point or 50 basis point, but what I think most important is the outlook, whether December is going to have another cut, and the scenario that's being presented by the US as in whether it will move into recession. The key thing is watch out for that yield curve going into normalization. All right, so I leave the Q&A later on. Next is that then what's up for the US indexes? The US indexes are presented here, which is NVX, which is NASDAQ. So what's up with the NASDAQ is that we've seen correction, meaning that we've seen from 2023 until now a blue color where I map in each of the correction. And each of the corrections since 2023 was about not more than 12%. Every time when it's dropped, not more than 12%. But the recent correction, we saw a movement of about 15%, 15.8. So although it doesn't qualify for a bear market, because bear market statistically we need to see consistent movement of a decline of about more than 22%, 22 to 25%, right? We've not seen that. But I think that we should read it together with the yield curve inversion together. Now, assuming that there could be a correction, then what's the past given us some clues is that in the past, right, the correction that we've seen around 2019 and the correction we've seen around 2020 was about 23% to about 37% maxed. Okay, so if we do a bit of a simulation, assuming that the stock market NASDAQ is to drop a 30%, not saying that it's a 37%, will it still be in an uptrend? So this is something that we are interested to know. if from the high, it drops about 30%. So based on technical, if I were to draw in that line, the black color line there, then a drop of 30% would still warrant NASDAQ still in an uptrend. Okay, which essentially means that if it corrects a 30%, somewhere near to, let's say, 14,000 would still be in an uptrend situation technically. All right, but if we talk about, let's say, a 50% correction, then no. All right, then that would break that trend line. All right, now next, let's take a look into the shorter term right now. As I was looking at NASDAQ and the various US indexes, today is a down day. Yesterday was a public holiday, no trading for the US market. But if you take a look at the moments where the US market right now, okay, you start to see that it is in this zone where I've drawn in this Fibonacci retracement, which is a very common technique, right? To know whether price is near to the high or low. So if we take a look at the highest point and label that as 10, and the lowest point as 1, which is here, the lowest point here, right? Then NASDAQ has corrected about 70%, which means that it is just about 30% from the high. Okay, technically, to be attractive in terms of maintaining a sustainable bull, my opinion is that there should be a short-term correction. That means it's probably too near to the high for price to move up higher. It's facing a bit of a, technically we call that a resistance. Okay, so my viewpoint is that at this moment we should see some correction coming in for NASDAQ, some weaknesses. Okay, because logically it's near to the high point. Okay, all right. Now if we take a look at, for example, it doesn't move. Okay, if we take a look, for example, which is S&P 500, it has a little bit of a different scenario from NASDAQ. Now S&P 500 behaved slightly stronger than NASDAQ to the fact that when it recovered from the recent correction, it actually went so much nearer to the previous high. Okay, so in terms of outlook, and if you take a look at the indexes, because S&P 500 has tech stocks, which comes from NASDAQ, and as well as some stocks, right, that came from Dow Jones. And we know that Dow Jones has been moving better than the NASDAQ. So it seems that S&P is having a better recovery, but in a way, if you look at technically from the short term, S&P is near the high. But assuming that we take a look at the blue color correction, where in the past S&P corrected a maximum of 35%, 27% to 35%, and we do a simulation, assuming that on average it corrected 30%, then S&P would still maintain that uptrend. However, technically, that uptrend trend line that I've drawn here, which is the black color line, would have been broken, assuming a 27% correction. Now, this means that from the viewpoint that S&P shouldn't correct too much. Okay, yes, we expect the NASDAQ to correct a little bit more, which is acceptable, but for S&P to correct a 27%, as you can see, it will fall out of this upsloping line here. So a healthy correction for S&P should be around, based on my projection, of 15%, or at least remain above that 22%, which doesn't make S&P into a bearish market. Okay, so in a way, if you look at, if Temasek is going to invest $5 billion, then my point is that each correction will be good, but there should be an extent to how much it should be corrected, and that correction must be read together with the yield curve inversion. Okay, in case that it really led to a market crash. All right, short term wise, which Jamie will cover how to use the warrants for short term trading. Of course, that if S&P is to break the all-time high, above 5,670, that would send it to new high. But short term, if it doesn't and it closed below 5,560, that means that there might be a slight, or rather some bearish movement for S&P in the near future. Okay. Now I come to the end of this presentation. If you do have any questions, you can ask me over the Q&A. I'm also posting a lot in Moomoo, especially on videos that I made, for example, on the Hong Kong stocks, US stocks, Forex, etc. So if you like to follow me, you can scan the QR code, or you can just type my name, Binni Ong, and follow me, because I post a quite fair bit of things in the Moomoo platform. All right, thanks a lot. I'll just pass the presentation to Jamie. Thank you.
Hi everyone. My name is Jamie. I head up the Warrants team at Macquarie Warrants, Singapore. I might have seen some of you at Moove Fest. Just a show of hands, how many of you were not at Moove Fest? Oh, okay, what a pity. But lucky we have some giveaways that hopefully will make you feel a bit less sorry about missing out. At the same time, obviously, we have got Binni's view. And I am about to tell you about the warrant instrument that you can potentially use to trade your short-term view on the US market. And before I go on, just a show of hands, how many of you are long US shares? Nvidia investors, please stand up. Okay, I think the headlines, in the past 2 weeks has been a little bit worrying. Having said that, what I've heard, hearsay only, every time Nvidia is down, people think it's a chance to go in. But if it continues to pull back, obviously all of us are going to be a little bit worried and scared, right? So I'm here today to tell you about an instrument that can potentially, hopefully, alleviate and insure against this kind of short-term pullbacks while you continue to average down or average up into the stock. Okay, so today's topic is how do we use warrants to leverage on the US market? Now, you might have missed out on freebies at Moove Fest, but hopefully with this instrument, you will not need to depend on freebies, to make money in the market. So what exactly are warrants? Why should we even consider this instrument? Why are you even spending 1 hour with us today? Apart from the fact that you've got cash vouchers and the really lovely buffet. It's because it's an instrument that aims, that aims to make you money. And really, I'm doing these sessions because I want you to make money via warrants, so that it can be a win-win situation. Now, those of you who are familiar with options will find this slide right up here very familiar. Why? Because we are essentially talking about only 2 types of warrants in the market. A call warrant, which essentially tracks the underlying higher because, the theory is that it gives you the right to buy at the strike price and a fixed expiry date, and it's suited for those who are short-term bullish. And then you've got a put warrant here for short-term bears or those who are fearful of short-term pullbacks. Why? Because if the underlying pulls back, then this put warrant will go up in price, right? How are they different from options? If you look at the name, you're probably thinking not very different. Why? Because they're named in a convention that really just follows the convention of its underlying, the underlying that is tracking. So warrants don't have a life of its own. It follows the underlying to move up and down. And how do you know what warrant it is? The first warrant here is an S&P warrant. And the second warrant here is a DBS warrant, for example. Now that's followed by MB, which stands for Macquarie Bank, which is Singapore's #1 warrant issuer, and some say in Asia. And then you've got the type of warrant, and this is very important because if you're bullish, you want to buy a call. Very good. I hope you really will buy a call warrant. Now, if you're bearish, you buy a put warrant. Okay, so this is important because ECW stands for call warrant and EPW stands for European put warrant. Okay, and then that's followed by 6 numbers in a year, month, date format. Now, warrants all have expiry dates, just like options, meaning you can't buy and hold like you will with shares. Okay, you're really using it in the short term only. And so, it has that year, month format. And if you can't remember any of this, it's okay. All warrants are identified by unique 4-digit alphanumeric digital code. In this case, XP5W, that's the S&P call warrant that expires on the 20th of December this year. So if you wanted to look for the warrant on your Moove platform, this really is the code you're typing in. Your $XP5W, for example, whenever we post about it on Moove community. Okay? They are listed on the SGX, they are listed on the SGX. They are a form of specified investment products, which means you have to be qualified in order to trade it, and are suited for more sophisticated investors like you, who can use it to hedge, which most of Singapore investors don't know how to do. Okay, I'll give you various examples of how the warrants perform so that we're convinced on why we even want to spend some time to understand this product. Now, I have the month-to-date performance. Month-to-date because I prepared this at the end of August and we're in the second day of September. But essentially, this is how the Dow Jones, S&P, and Nasdaq warrants have performed alongside the futures indices. Now, it hasn't been a particularly exciting month, right, for the US indices. As we can see here, the Dow was up, 0.8%. The S&P and Nasdaq a little bit, but still not very exciting, up 1.5%, up 1.3% in Nasdaq. However, if you look into the core warrant, even though the futures was up just about 1.5%, you notice that the core warrant is up 17.6%. Now that's 11.5 times more than the index. Now, ladies and gentlemen, this is a demonstration of gearing taking place. Why do people want to trade warrants? Why should you consider warrants? Precisely because of its ability to magnify your view. Okay, rather than just gain 1.5%, you have the ability to gain 17.6% and exit on that position. At the same time, how much do they cost? Have a look at the cost of the warrants here. They cost anything between 5 cents to 11.5 cents, meaning the capital outlay required of you is actually very, very low. You don't even need to put much money out there, to have a view over the US indices. At the same time, they're not a margin product, meaning your downside is capped. Okay, so gearing works both ways. Obviously, it can grow, 11 times more, but it can also come down 11 times more. But what is the good catch? The good catch is the loss is limited to the amount of money you place up front, which is very low, because bear in mind, they are very low cost, right? Low priced. And of course, the put warrants you see here all clocked negative gains. Again, they moved between 3.6 times to 5 times more than the underlying. So meaning if you short the futures, you should have been down 1.5%. But in this case, if you bought the put warrant, they were down around 5%. All right, because gearing works both ways. Now, speaking of put warrants, this is an example of how they perform in the month of July, and not too long ago when NVIDIA announced results. As we know, markets are pretty much close to their all-time highs. In fact, in July, we saw the S&P clock, a new record high, right, for example. And I think some of us who are long get a little bit nervous because then there's a lot of talk about recession, right? Data not being great. That's why the Fed has to cut, more times than analysts are expecting, etc., etc. Now, these examples here are meant to show you how put warrants will work. I like teaming up with Binni. I always think we are the Binni Macquarie indicator. Why do I say that? Because every time we team up and we show up at the seminar, whether it's by coincidence or not, the markets always move big time. 2 months ago, I had a seminar with her at another broker, and she was also covering on the US indices, especially Nasdaq. And she did call for a pullback of around, I think, close to 20%. Eventually, the market came off. So we did it at the start of the month. And by close to the end of the month, the market had already come off about 7%. Eventually, I think it came off about more than 10%. And one of her support levels was actually 19,000. So if you were one of her loyal supporters of whether of Binni or Macquarie / Binni, and if you're traded on that view now, you would have made between 65% to 190% on the put, and this is during a 10-day period, right? Or if you were a tech shareholder and you were a bit nervous at the potential pullback that might happen, rather than see 7% loss on your portfolio, you could have hedged with the put warrants here. Likewise, we ran a lot of articles leading up to the NVIDIA earnings report prior to 26th of August, We ran a lot of that. We posted it on Moove community. And again, if you're one of those who heeded our call, you would have seen, the Nasdaq futures come off about 2%, mainly dragged down by Nvidia, which had its biggest pullback, right, for a long time. But instead, you rather than see the 2% pullback on, your portfolio of tech shares, or even more if you're holding individual tech shares that came off more, you would have been able to insure yourself with a 14 to 15% gain via either of these Nasdaq put warrants that we have for you to hedge your portfolio. So ladies and gentlemen, this is why we hope that you consider trading warrants, or at least use warrants to your advantage, whether or not you're thinking the indices have got, more legs to run in the short term, but you're not very confident, not confident enough to be a long-term holder, you can use call warrants. Or if you were worried about your portfolio of shares, you could potentially use put warrants. Now, some people are not insuring against anything. They simply just want to profit from pullback, that they've heard experts talk about. Okay, so how do you select a warrant to trade? Now, earlier I talked about how warrants are like options. And in fact, warrants are a form of put options. However, two main differences. One, warrants are traded and listed on the SGX and not on the derivatives market, right? Or over-the-counter markets like exchange-traded options or OTC options. That's one. The other big difference is, with warrants, there's a presence of a market maker, of an issuer like Macquarie. Meaning, we are the only ones with warrant inventory. We're the only ones who can sell a warrant to you. So whether or not you are bullish or bearish, you always only buy. Whereas for option traders, you will know you can short an option to earn premium, right? But what does that mean? Well, that means two things. You can do a lot of strategies, your butterfly, straddle, strangle, and all the complicated strategies, or you could potentially face unlimited losses when you are able to short sell option and earn premium, right? Especially if your view was wrong. So with warrants, you don't face that. Why? Because you can only go long, right? And if you wanted to cut out, you cut your losses and you exit. All right, so essentially there are only 4 steps. There are no option strategies that you can employ with warrants, really. It really is, first, what is your view on underlying? You must have a clear view on the underlying. Where is your target entry? Where is your target exit? Where is your cut loss? And with that in mind, you literally enter and exit and cut loss based on your view on the underlying, not the warrant. Okay? Second, you need a holding period, because warrants, just like options, you can't hold on to them forever. You need to be disciplined on cutting your losses or taking your profit whenever your target exit level has been reached. Third, as you can see from the examples I've showed you, some warrants grew 3 times more, some warrants grew 8 times more, some warrants grew 12 times more. Now, there are different levels of gearing. The more they move, obviously, the higher the risk they are. So what kind of risk profile do you have? And then you can select the warrants appropriately. And last but not least, always buy any financial instrument on tight spreads, because it's the most cost effective. So only select a warrant that's traded on tight spreads and not wide. Okay, I'll give you a quick example, a live selection based on what Binni talked about. What underlying are you all interested in? Nasdaq or S&P? Will you all pay attention to the levels she talked about? Anyone? First of all, are you all bullish or bearish on the US index? Is there a consensus here? Anyone? Bullish or bearish? Confused. So don't do anything, okay? Don't even buy a warrant, because if you think you don't know where the market is going, or you think it's sideways, don't do anything, right? Because you only take a position in the market or via warrants when you think that the market's moving. If you think it's going to take 10 years or 5 years for your level to be reached, then also don't buy a warrant, right? It's only for the short term. Now, this is warrants.com.sg. This is our website, and some say the best warrant website in the world. Why? Because we invented tools just for you to trade warrants in a smoother way. Now, when you're warrants.com.sg, you go to warrant tools and you select the warrant selector drop down. This is one of those tools I said we invented to make warrant selection and estimation easier. Now, I took notes. Basically, if you're looking at the S&P, okay? Because I only saw 5 hands stating that they were tech share investors. So if we're looking at the US market in general, S&P is probably a good index to look at. Now, apart from the person who thinks he's confused, do you all think it's going up or down in the short term? Up. We're in September, right? That's where we're all bracing ourselves for how many rate cuts we could be expecting. So some say we're bullish. Do you recall what the resistance Binni had mentioned? If you're bullish, I think it's probably important to look at resistance levels, right? Because when it surpasses those levels, it breaks above, you probably want to get even more bullish, right? But at the same time, if it looks like it's hesitating and then it starts pulling back, for some people, they believe that resistance levels are profit-taking levels, right? The level they want to get out before they kind of recalibrate and decide. Now, if you weren't paying attention, let me help you. A resistance she talked about was 5670, which is not too far away. Okay, so if we were bullish, we would select a call. But with the market currently at 5634, there isn't really much room, okay, for this warrant to perform. And I'll show you in a quick bit. If you're bullish, you select a call, right? Now the target price, let's say we want to get out at 5670, which is the resistance she talked about. Okay, we enter that and it's only 60 bits away, 0.6%. You increase the number of weeks and you'll find immediately that if that happened tonight, all right, the very next day, the warrant will be up between 6.2% to 16%. All right, there are really only two warrants for your consideration here. But if it moved up 60.6%, 60 bips, 2 weeks from now, then this first warrant will only make 2.5% gains compared to today or tomorrow. Why is that? And then the second warrant here is down 14%. Anyone knows why that is? Why is it that if it takes another week for this view to actualize, even if the futures was up, the call warrant will in fact be down? Time decay, fantastic. That's why you're seated right at the front. Thank you, sir. Time decay. Now, every financial instrument has got a holding cost, right? They all have a catch, so to speak. What is it? They will charge you holding costs, right? For some instruments, they charge it at your P&L, the P&L ledger. Some of it is reflected within the warrant price and the product price itself. In this case, with warrants and options, the time decay happens within the product in that the longer you hold, the more time decay you pay, meaning the more the warrant value will decrease with time, okay, accelerating towards the end of the warrant life. Now, in this case, in 2 weeks, the second warrant here will straight away be down, so obviously you wouldn't consider it. Now, if all this looks very gloomy, obviously if you increase the number of weeks, you'll see that it gets more negative, right? If it looks gloomy, all it takes is really for the index or you to have a view that's a bit more bullish, right? Because you're bullish. So in this case, let's say, for example, if we think the market's going to 5,008, you will see immediately in 2 weeks, both warrants will be highly positive. That's a big change from what we were looking at earlier, right? Where the second warrant was down 14%. Now that will be up 62% in a week's time. And in 3 weeks' time, the first warrant here will still clock gains of 18.5%, which is about 7 times more than the index itself. And this is why you probably want to use a warrant to trade a short-term bullish view, okay, because of its ability to magnify gains. What is the maximum amount of time you can hold on to these warrants with such a view? The second warrant here says it would have expired, so you probably want to ignore it if you have a view of more than 3 weeks, because again, you're just going for FOMC, right? Maybe you want to hold it for at least a month to see what happens. Now, all you have to do is you keep increasing the date here and as you keep increasing it, you find that the percentage gains shrinks. Again, why? Time decay. Now I've increased it to 6 weeks and you see that this first warrant here will only increase 3.7%. Now there is no longer any leverage. Well, it's very small, right? Compared to a 2.9% gain in the futures. What this means is that the maximum holding period with this warrant is 6 weeks, okay? If you have a view that the market will go up 3% from here. Now again, if you want to hold for longer, what this means is that you just need to increase, you need to be more bullish. And therefore, again, this product is for those who have very strong view that the market will make a very big move in the short term, okay, whether on the upside or on downside. Again, if the market goes up 6.5%, you keep increasing the number of weeks, and you can see that you can afford to hold on to this for 12 weeks, and this warrant will still gain 12.3%, which is more than the futures move. But of course, the gearing drops, right, to about just a 1.5 time gearing. Okay, so this is how you use the selector tool. What happens if by 12 weeks, the market doesn't hit 6,000? Your target level is 6,000, so the market doesn't hit there. What happens? What should you do? This tool is telling you, even if your view was reached in 12 weeks, it will only generate 12.3%. So what should you do if it doesn't get there? Let's say it's unchanged. Anyone? What should you do? You're silent because there's something even I am guilty of. You should cut loss. Okay? We don't cut loss because we think, oh, it's really, let's say if it was unchanged, if it remained as what it was today, which is about 5635, we think, oh, it's really painful to cut at 65%. But remember, warrants only require a small capital outlay. So in terms of absolute loss, it's probably quite small, and sometimes it could be smaller than, you know, your absolute unrealized losses in your stocks that you're currently holding. Okay, so with warrants, you just need to be very disciplined with cutting losses. Now, someone was bullish, but how about we revisit this S&P and talk about a bearish view, because Binni was talking about a support level, what was it, 5540? Okay, which is a bit further. So if you were bearish and you think, okay, the market is due for a pullback because the resistance looks, you know, you think you want to pay heed to Binni's resistance level. If you were bearish, you basically buy a put warrant, right? You will get out of the put warrant, you take a profit when the support level is met. Why? Because when we think there is a support level, we think the market's going to hold in the short term, right? So we want to take our profits unless we think it's going to break through, but that probably takes a bit of trying, right, of the market. Now let's enter her support of 540. That's 5540, Binni?
Yeah, I think so.
Okay, that's about close to 2%. And again, if you were wanting to trade that view, just simply increase the number of weeks, and you can see that by the third week, you really should be exiting on this position. Okay, and that's how you use the selector tool. But of course, if that happens in a week, then 1.7% move can happen overnight more often than not. Then if it happens overnight, you'll be collecting a 17% gain to hedge against, you know, your portfolio of US shares. Or if it took a week, you'll be collecting 12% gains to hedge against your portfolio of US shares. Okay, that's how you use in the short term. Now, what if the US keeps going up? You bought this to hedge. What should you do? Anyone? Cut loss because you bought it as a hedge. So you'll be making money on your current portfolio of shares anyway. You used a small amount of money, right, to buy insurance via the put warrant. And if it doesn't get there, cut your losses. Okay? Now I would just like to go back to my slides, and I'll tell you very quickly how you can use, how you can estimate how much money one should put into the warrant if you are looking to hedge. Okay, so we've gone through the selector tool. I think we've got time for the calculator tool. Now, this is one way which you can use to estimate how much money you should be putting into your warrant investment if you're looking to hedge. So for example, again, for those who are holding on to NVIDIA, you're a little bit nervous in the short term, and you're looking at this NASDAQ put warrant, you use ZW. Okay, in this case, the warrant has got effective gearing. The warrant has got an effective gearing of 7.5 times. How do I know that? It's on our website, warrants.com.sg. It's all over the website. You know, as long as you click into it on the warrant search table on the warrant terms page. And this costs about 10.1 cents. So if you're currently holding on to $100,000 worth of NVIDIA shares and you wanted to hedge using a NASDAQ put warrant in the interim, all you have to do is divide your portfolio of shares by the effective gearing level of 7.5. Why is that? Because when NASDAQ goes down by 1%, this warrant will go up by 7.5%. So if you invested the $400,000 into the put warrant, you are in fact now betting on the market coming down and hoping to profit from it. So if you're looking to hedge, then you only need to invest $13,000 in this warrant. And how many of how many of these warrants should you be buying? Simply use the investment amount, divide by the offer price of the warrant, which is 10.1 cent, and you basically need to go into your Moomoo platform and type in UUZW buy 133,000 units at 10.1 cents. Okay, that's how you can estimate how much you should be placing into the warrant in your investment dollars. Now, to see how this warrant will perform after you've bought it, we've got another tool known as the Live Matrix tool. Again, it's found under the warrant tools drop down. Invented it to make warrant understanding easier. Like I said, warrants follow the underlyings, right? Put warrants move inversely. And we have got this tool called the Live Matrix, which shows you live every day, including tomorrow morning during Singapore trading hours. Why? Because US index futures trade 23 hours a day. So actually it trades during the Singapore trading hours of 9 to 5 p.m. And then we shut at 5, meaning we will not move. But the next morning, the futures will take into account what the US did overnight. And so you can exit a position the next morning at 9 a.m. Okay? So from 9 a.m. onwards, you can see how the warrants are following the futures to move. And you get a sense of how they, what the bid price will be, based on the US index futures bid, and where the offer price will be based on the index futures offer. Okay, that's why I say only need your view on underlying, because the warrants track it, and you just need to exit based on where your view of the underlying is. Okay, if you think that you want to exit, for example, in this case, you want to exit when the futures is at 3719, right? What price will the warrant be? 8.2 cents. Go into your Moomoo platform, type 8.2 cents, sell. Okay, that's how you use the Live Matrix. Now, we have a warrant search tool which makes searching up a warrant really easy. We know Singaporeans like shortcuts, so we've provided a fire logo to tell you which the trending warrants are. What are trending warrants? They are those that are on the tightest spreads or with the highest liquidity. Like I said, don't buy a warrant that's on wide spreads. It doesn't make any, it's not cost effective at all. It's harder for you to make money. So we have a fire logo to tell which are the warrants on tight spreads. Of course, there are other warrants that you can choose from if you disagree. Now, every product comes with risks, so it's my duty to remind you, gearing is very attractive. It's the number one reason why people trade warrants, because of its ability to move, that 12 times, 13 times, 20 times more. And I guess some people think it's a quick way to make, a large amount of percentage return, but it works both ways, okay? Take heart, the maximum loss is 100% if you choose to hold on to the warrant to expiry. We generally don't encourage people to hold it to expiry. You should be entering and exiting based on what the selector tool has simulated for you, like I showed you. It didn't tell you to hold it all the way to expiry. It told you that it stops making you money at the 12-week point, stops making money at the 3rd week point. So, you have to cut your losses and exit before expiry. Typically, those who hold to expiry get 0 back. So meaning the maximum loss of 100%, but that's it. With options, you obviously have to, it's unlimited, right? It's more than 100%. And with any margin product, in fact, okay? So they've got limited life, and how do they compare to other leverage product that you might have heard about and you will hear about that's available for trading on Moomoo? Now, each product has got their own unique features. So for example, with warrants, we're a form of options, as I said, right? So we've got time decay and implied volatility factors that impact the warrant price. But we don't have other unique features that is found in other products like the airbag or compounding. And then we don't have finance charges. And more importantly, we're the only product that's following the actual futures index. So if you are, you're a seasoned future trader, right? You know the difference between the futures index and the cash index. You know that you always followed futures because that's the only tradable kind of index, right? And we are the only ones tracking that. So if you're already following the futures market, then yeah, our product tracks that exactly. We've got no roll costs, right? So if you had like a 3-month holding period, you don't need to roll out into a new contract every month as you would need to do with the futures. We don't charge you interest, etc., etc. All you pay is the brokerage to Moomoo, which is minimal, okay? And of course, the cost that you pay is whatever you pay for the warrant, and that's it. Okay, now, if this session was not enough, I do have 1-minute videos for you to look at on the way home that covers the concept of warrants. At the same time, if you share any of these videos on your Moo community app, you stand to win you wish, $8, which quite a couple of, this is exclusive to Moove investors only, so we don't have it available anywhere else. You get $8 Grab vouchers, hopefully covers your cab ride home. We also have a $100 giveaway to whoever trades warrants, okay, and you post about it. And again, for more information, you just need to join Moove community, and it's all there. I mean, this sharing is probably the easiest. If you haven't followed us, here's the QR code. Once you follow, my colleague out there will give you a really pretty disposable bag. And finally, I should probably give you a heads up. We will be running a rewards campaign with Moomoo from next week onwards. It's going to be very attractive. Potentially, you could win up to $450 as long as you trade warrants for the first time in the last 3 months. So please keep a lookout for that. I hope you're one of the winners. The aim of the rewards campaign is to reward you for trading warrants, but it's also to help you offset some of the holding costs, right? The time decay you have to pay. But all in all, we hold a lot of these sessions because we hope that you'll make money via our product and come back again and again. So if there are any questions that you might have, please feel free to ask me. Otherwise, if you're too shy, we're always available. Website, we've got our number. Email me, okay? Here's my promise to you. If you're trading warrants, I'll be there to handhold you. Thank you very much.
Thank you, Jamie. So I'm back. Yep, so I hope you're able to learn something from Binni and also Jamie. So now is a very quick session on the app demo in terms of how you can use access warrants on the Moomoo app. So before I start, just want to stress again the importance of knowing the warrant codes. Some places where you can find the warrant codes are the warrant website, social media channels, financial terminals like Bloomberg Terminal or Yahoo Finance, and also brokerage platform like the Moomoo app. Yep. So if you have the app with you right now, you can. Yeah, these are the pictures of some of the platforms that you can find the warrant app codes. Yep. So if you have your phone with you right now and you can open up your Moomoo app, I can just walk you through how you can find it. It's going to be very quick, 6 steps only. Yep. So maybe just give you 1 minute to open the app. Yep, okay. So if you're on the home page right now, when you log in, you click on Markets, can be found at the bottom of the app, the second button there. And then after that, click on SG at the top, where you can see here. Don't worry, the team will be here as well to help you after the event. So if you have any questions, just let us know. Yep, so after you click on SG, you'll come to this page. And then at the middle of the page, you will see a few options, and one of it is warrants. And then you click on it. Okay, so after you click on warrants, you will come to this page where you have a list of warrants that you can choose from. And then what you can do is, this list is a very long list of warrant codes, and then you can go in, you can click in, choose one of your preferred investment product, click it in, and then you come to this very warrant-specific page. And then this is where you can start trading. Yep, so you can buy, sell, up to you. Yep. Okay, so remember why I say knowing where to find warrant codes is very important earlier. So this is why. If you have the warrant code beforehand, what you just need to do is when you log into the Moomoo app, there's a search button at the top. You can just search the warrant code. Yep, so if you have any questions regarding how you want this app demo, I'll be around after the event. You can ask me, you can approach me. Yes, so now that's all I have. I'll move on to the Q&A section. As you can see here, there's a QR code. You can scan the QR code to ask if you have any questions for Binni or Jamie, and I'll redirect the questions to them. So for people watching us on live, you can submit the questions through the chat, and I'll redirect the questions to the speakers as well. Okay, I have one question in. So the first question is, yeah, I think this was answered earlier. So maybe this question was asked before Jamie answered it. So it's what are typical fees or costs associated with trading warrants? There's a few more questions. Yep. So the brokerage, the Moomoo, yeah, by Jamie. Okay, so I think there's a few questions coming in. So first, do warrants have assignment risk like option? Do you want to come up here?
What's the question?
Do warrants have assignment risk like option?
Not sure what you mean by assignment risks, but basically, like I said, warrants are a form of option, right? In fact, when you buy a warrant, what we do as an issuer is we go into the warrants options market and we hedge ourselves there. Especially with the gamma risk, if you're familiar with the concept of options. Otherwise, I'm not going to explain what the gamma risk is. But yeah, as such, with warrants, the risks are really just restricted, right? Because you can't long and short. You can only long, right? As with all securities on the SGX, you can't go short. You can't go naked short. If you went short during the day, you have to cover the position. So as such, there wouldn't be, the assignment kind of risks, right? Because, and I think if you're talking about delivery, there isn't such a thing as well because all warrants are cash settled. And so at the point of expiry, if you hold it to expiry, like I said, you shouldn't. But if you do, then basically it finishes worthless. It just finishes zero. You don't take delivery of any shares or futures as you would with options, I believe. Especially index options. You do take delivery, but that doesn't happen with warrants at all. So there's no delivery of futures that you have to take at expiry. There's another question, if I understand correctly, with a gearing ratio of 7.5, a 1% move in the stock, the warrant will move approximately by 7.5%. You're exactly right, Anonymous. You have brilliant understanding. How does the market maker make money? That's a frequent question that people like to ask, and in fact, something we talk about in our more advanced sessions. So you probably would already have guessed it. How do you make money, sir? How do you think we make money, sir?
Bid and ask.
Bid and ask spread. Very well. I thought you were going to talk about what you talked about earlier, which is, first of all, he talked about bid and ask spreads, which is how any market maker of any product makes money, right? Because we're quoting on both the bid and offer. So imagine if he buys and you sell, I've already made a spread, which is why we say buy warrants or any product that's on the tighter spread. If you trade a shares, you also want to buy on the tight spreads versus like one on the elephant spread, right? So bid and ask spreads is one way we make money. But of course, if you hold the product, you suffer what? Time decay, the holding costs, right? And where do you think time decay goes? Issuer, that's right. That's what we make, right? But what we also hope is that the gearing kicks in such that it overcomes and overrides time decay. And those examples I've showed you, if the S&P moved up 3% from here, the warrant will still move up 30%, 40%, even with time decay. Even after 12 weeks has passed. Why? Because the gearing has overcome the time decay such that time decay doesn't matter in this case because the gearing has override or overwhelmed it. And then there's another question, is there a difference between DLC and warrants? You're new, yes. So I showed you a slide earlier. So there are differences because each product has got its unique features. They don't have time decay, they don't have implied volatility. Their holding cost is something else. We don't have what we call the compounding effect. So basically, if the warrants was sideways, I can't speak for another product, right? But if you're familiar with DLCs, you know the compounding effect, right? For us, and it's even if the market was eventually going to go up or the stock was going to go up because of compounding effect, and if it was sideways for a long time, you might not make the geared returns as promised. That's because of their compounding effect, but we don't have that. So if the market was sideways for a while, but eventually it does make the big move, in your favor, the gearing is still going to kick in, overrides the time decay. The concept is the same as what I've just explained, and you eventually still make money, all right? You still make the geared return. So it's different that way. We also don't have an airbag mechanism. So when the Nikkei basically dropped about about 20%, for example, some stocks, Hong Kong stocks especially, they can drop more than 20% during the day. It doesn't just, get triggered and then go to zero. If it rebounds the next day by another 20%, you have a chance to not make any losses in the product. So, I mean, these are how unique features work. Of course, yeah, like I said, they will tell you they don't have time decay, implied volatility changes, etc. So it could be a easier product. But whichever is easier or not, I'll leave you to decide. Obviously, my promise is I'm here to help you out, and we invented tools to make it easy. And ultimately, hopefully, whichever product makes you more money, I think that's the winner, and that should be the chosen one, right? How do we calculate leverage limit for selling warrants? You're talking about the sell limit? Is there a sell limit on Moomoo? Is that what you're talking about? Also anonymous, is that what you're talking about? The sell limit on the platform? So if you're talking about, so the limits, the buy and sell limits should pretty much be exactly how it is to trade shares or any other instruments, right? Because my belief is that on Moomoo, you have to put cash up front, right? To trade whatever you want. So the limit is just however much you want to put up. Now, if you're talking about earlier when I showed you how you can use gearing to decide how much to invest in a warrant, if you're asking if that's the same way you used to exit, no. So you exit, right? So remember, step one of choosing a warrant, target entry and exit based on the underlying. So if you want to exit because either you want to cut loss or the underlying has reached your target view, right? So you just sell out everything. Of course, some people think, I just want to sell 10% first, I want to sell 50%. That's also your call. That's a strategy you have to decide. A game plan you have to decide from the get-go. But basically, you sell, you just sell the whole chunk that you have bought. So the effective gearing level is really used for you to decide how much to buy. If you're looking to hedge, or even if you're thinking, okay, I will be putting $100,000, in Nasdaq, or I'll be putting $50,000 in the S&P ETF. But now I'm not sure whether it can go up in the long haul. So how about I try warrants? Now, if that was your intention, 50,000, and you looked at a warrant with a gearing of 7.5 times, you basically don't put in your 50,000 meant for a long-term holding. You use that 50,000 divided by the 7.5 times gearing, and then you enter this product, okay? And then you basically exit on the full amount that you have invested if you have reached your target level or cut loss level. Okay, I hope that answers your question. What is the difference between warrants and options, especially with managing losses and rolling? Additionally, are option concepts applicable with warrants? Now, no questions for Binni before I go on. Binni is sitting there like looking at her nails. So yeah, let me just address some of these questions. Basically, I would otherwise have had the slide on warrants and options, but warrants are a form of options, and yet, like I've explained, they are different because you can't sell a warrant, you can't short sell a warrant as you will with options. Meaning, if you're a seasoned option trader who now wants to try a warrant product, you can't use any of those strategies. Some people like to use options because to them, they don't have to take a view. They're only taking a view on whether there's going to be volatility, right? As long as there's movement. You can't do that with warrants. Sure, the implied volatility of warrants will increase when option volatility increases generally. But as much as possible as a warrant issuer, we try to keep implied volatility levels constant. Why? Because you imagine it's very frustrating as a trader or investor if implied volatility was swing about all the time. Because now not just you need to have a view on underlying, you also need to have a view on where volatility is going, right? So we try to, as much as possible, minimize that. And so if you're one of those who just want to use options to have a view, take a view on volatility, to long volatility, sorry, you can't use that with warrants. Warrants, I would like to say, is a more straightforward product. It's really a means to an end. If you have a view that the market is going up or down quite a bit in the short term, and you don't know if it's going to continue or sustain that trend in the long term, you use the warrant. You buy a call if you're bullish. You buy a put if you're bearish. It's as simple as that. You apply the target levels. That's it, right? I think options is a lot more complex with all the strategies, right? So it's different that way. I hope I've answered your question. I think some of you look a little bit hungry, so I'll look at the last question. There is, are we able to enter an order that's triggered only when the price? You can queue. So just like how you queue on futures, on shares, you can queue, you can put in a price, a limit order to queue on the warrant. And what warrant price should we be placing? The answer lies in the live matrix tool that I put up, or the selector, or the calculator. I didn't have time to go through the calculator tool. Or I like to say the easiest way is just call warrants.com.sg, Jamie, call me 6801-0189. Me and my colleagues can tell you exactly where the warrant price would be based on your view on underlying. Okay, and you simply place your order. Of course, you can hit the market right away, or you can choose to queue. Okay, your call. At this point, I should probably throw in a promotion we currently have. We're offering interested investors, especially for US warrants, the ability to buy on a bid price. Typically, we always buy on an offer, right? That's the selling price. Now you have the ability to get in the bid price for any of the US index warrants if you're interested. Just need to call us and you get your orders filled there. Okay? All right, so that's the last question. If you have more questions, please come up to me. Otherwise, I believe there's a buffet dinner waiting for you.
Thank you, everybody. So you can, those of us who are here with us physically can slowly make your way to get your food. And those who are watching on the app, good night. Thank you. So if you have any other questions, please approach the speakers. They will be around. Yeah. Thank you, guys.